Hello, everyone, and thank you for tuning in to the update with Oakwood Financial Group. I'm Joshua Dobi. Appreciate so much your continued willingness to embrace this medium and this means of update for you. I hope that this finds you well and that you have continued to live through and work through this time of COVID-19. And I pray that your health is good, and if you are among those who have experienced COVID-19, that you are on the mend and hopefully in a space of recovery and returning to, quote, normal as quickly as possible. I want to provide for you an update about where things are. A lot has changed since our last update time together, and I want to be able to give you some insight to that, up to and including the signing of new legislation in Congress this afternoon, as of the time of this recording. So it's going to be a couple days afterwards that you're actually hearing this, but it happened this afternoon. Wanted to be able to give you some very quick reflections on it because it hit the president's desk a little bit earlier than anticipated, and so it is now indeed law. So I want to make sure that you have all of those pertinent points, not all 680 plus pages of the bill itself, but certainly those things which may apply to you, loved ones, colleagues, other folks that you may know. So to be respectful of your time, I'm going to go ahead and dive right in. First, let's talk about markets, and I'll get to the legislation here in a minute. There has been several interesting developments as we've continued to make our way through the first quarter of 2021 here, especially when we look at it in relationship to what transpired in 2020. So just do a quick recap on 2020. Started out the year pretty healthy. Then we had COVID hit in late March, early April there. So we had the mandated government shutdowns. We had severe restrictions on travel and in all of the usual kinds of movements that we would make. And then we had a corresponding drop as far as the markets are concerned very quickly within a couple of weeks there, end of March into early April. However, from that point, as far as the markets are concerned, we had some pretty significant increases out of that time, all the way to and including, if you looked at the market indexes by year end, they actually turned out just fine. Meaning if you somehow could set aside the market impacts of COVID or even your experiences earlier in the year and just looked at the end of year results relative to January 1st, insofar as the most popular indexes are concerned, you probably felt pretty good about where things ended up. Obviously, there was a lot into that. But it was good to see that the market indexes ended the year in such a very positive fashion at the year end. And that was led primarily by a handful of industries, handful of companies on a relative basis that did very, very well. And you've heard me talk about the dichotomy in the markets that we saw in 2020, and they certainly ended out the year that way. Primarily on the good end of things, or on the positive end of things, if you will, you had technology companies, biotechnology companies, those kinds of companies which were very much part of what was called the work from home or live at home strategy, or companies that played into those kinds of services that we were using during that time because of the restrictions due to COVID. So you had the biggest companies, which are most familiar to almost all of you. Apple, Amazon, Netflix, Facebook, Google, again, big technology companies that really powered through. And then you had some smaller companies which really came to the forefront during the time of certainly work from home, live at home kinds of things. Things like Zoom video communications. I mean, I don't know about you, but I almost am proficient at this whole Zoom video idea. Whereas before that, we used it on a relatively small basis or relatively infrequent basis, but used it a whole lot through 2020. That company, public, and of course had a fantastic year from a performance standpoint as we look at, again, those companies that did very well. So you had technology companies, both large and small, which did very, very well over on this end of things. And then you had a whole host of companies over here which were just decimated. And obviously the ones that quickly come to mind, hotels, hospitality-related companies, restaurant groups, airline companies, mass transit kinds of things, sports and entertainment kinds of companies that were just decimated during last year in 2020. Then you also had financial companies, most especially money center banks, which because interest rates came just crashing to a near zero as the Federal Reserve sought to keep the expense of doing business as small as possible, You also, again, had money center banks or financials that had a terrible year last year. And then on top of that, also oil and energy companies. So the more traditional oil companies or gas companies, which just had a miserable year in 2020 as well. So you had all of those companies over on this end of things, which really didn't have a good year. Giving you that background, that refresh on 2020 to provide the change in look that we've seen so far in 2021 here, and it's been primarily due to one macro factor, although there is always a greater number of factors than one in these kinds of movements. But in 2021, we've seen a significant reversal. Those big tech companies have lagged behind, not terribly negative, but definitely have lagged behind. And those more traditional companies that I just talked about, financials, oil, and energy, are actually some of our market leaders. Now, I know it's not even the end of Q1 or the first quarter of 2021, but it's been interesting to see how those companies, which were laggards last year, in many instances, have been the ones out in front this year. Which of course begs a very understandable subsequent question. Whenever you know that and whenever you hear that, well, why? Well, again, as I mentioned, one big factor, but there are always a number of factors involved in that algorithm. The primary big factor, though, is that almost beginning on January 2nd, we have had a bump up in the interest rates of bonds which are traded in what we call the secondary market. So the Federal Reserve, relative to new bonds, is still keeping things at a very, very low level. However, when bonds are trading in the open market or the secondary market, those prices and those relative yields are moving all of the time. And that's the kind of thing we always know that's out there. We see that's out there. It's something we watch very closely. But what happened is those yields on a percentage basis have jumped up significantly. Towards the beginning of the year, they were just a breath below 1%, at least as measured by the U.S. Treasury 10-year bond, meaning the 10-year Treasury was right around 1% or a little bit below, actually 1% coming into the year in the secondary market trading. It has steadily risen since that time to be in the 1.5 to 1.55, even topping out in the 1.6 range percent per year. Now, you may be looking at that saying, well, it's only half a percentage point. Why is that such a big deal? Fair sentiment, except when you look at it on a percentage basis. And when you look at that on a percentage basis, you're talking about a 50+% increase in rates on bonds, which are, again, trading on the secondary market, which is huge in my kind of universe. Because not only is that significant in terms of what the market is anticipating with regards to where interest rates are, but then it starts to knock down a very significant line of dominoes as far as ramifications for our market are concerned. And then specifically, coming back to what I mentioned just a few moments ago, those kinds of companies which tend to do well in a higher interest rate market. So let me just take a couple of moments and talk about why that may have been the case or why rates may be moving up in this kind of environment. I don't need to tell you, and I'm going to talk a little bit more in a few moments here about the new legislation that just came through Congress, that we have in extraordinary ways in the last year both increased our national debt and increased the number of dollars in circulation as we have been funding these COVID-19 related financial relief bills coming through Congress. So without getting into the political aspect of things, it's just a mathematical fact that there are a significantly larger number of dollars in the system. There's been a significant increase in our national debt, and there are some dominoes that knock down from that. Now we're talking about the idea of inflation. What comes along with inflation? Often, not always, but often, a bump up in interest rates. So the secondary market has been looking at the number of dollars that have been circulating, looking at the kinds of things that are coming down the pipeline in terms of what may be additional national debt. And the secondary market for bonds then has begun trading in anticipation of those higher interest rates and possibility of higher inflation. Now, we're not there yet, but the markets, as they often are anticipating what may be down the road. I'll raise my hand and say I did not anticipate that the market would begin reflecting that future possibility so early. And that's something that I think took a lot of us who watch the market closely by surprise, that those interest rates bumped up. Now, sometimes when those kinds of things happen, folks want to start thinking in straight lines and say, okay, went from 1 to 1.5, are we going to 2, 2.5, 3? No, not very likely when you look at it from a historical standpoint, but they have bumped up. And as they've bumped up, again, talking about that metaphorical line of dominoes, that has produced some effects that have been different market-wise, certainly stock market-wise, from where we were before. Bond values or bond funds or bond ETFs have come down in value because Econ 101, when interest rates rise as far as existing bonds are concerned, the value of those existing bonds tends to come down. And so we've seen that. We've seen some pullback in the value of bond funds and of exchange-traded funds that are trading in the market. So we've seen some of those values come down. We have also seen, I talked about the reversal as far as some of the industries which have done well, companies which have done well in 2021 as opposed to 2020. As these interest rates have risen, we've seen again some changeover into different companies, different industries, which are performing well. So you have things like oil companies, energy companies, financials, which lagged behind, as I mentioned, terribly in 2020, now coming to the forefront a little bit. Now, that doesn't mean that this is necessarily going to be a seismic and permanent shift in the marketplace. But because we're doing these updates with some regularity, I want to let you know the kinds of things that I'm seeing here relative to the marketplace and relative to some of the changes that we have seen. So that, of course, then leads right to the next question then. Do we expect this to continue, or what do we expect for the balance of 2021? Well, I'm going to start out with a terrible answer. I have no idea, just like every year that I've been in this business over the last 26 years. No way for us to know with any certainty. However, it does tend to indicate that there may be some different market leadership in terms of those companies which may end up doing well in 2021 as opposed to 2020. Very common kind of thing, very natural kind of thing to see some rotation into those kinds of companies. Very important to recognize that for what's happened to this point, but also recognize that things don't run in a straight line. That just because some things may be going this way doesn't mean that they're going to go that way in perpetuity. And also if some things are going this way, that they're not going to run that way in perpetuity either. So very, very important to keep in mind. It's almost always like waves on an ocean. Sometimes you're at the peak, sometimes you're at the trough, and a lot of the time you're in between somewhere. So that's where the markets are right now. Kind of interesting in terms of some of the rotation in market leadership. We're going to continue to watch it closely to see, especially with interest rates, and again, all of the corollary things which come along with that, are going to maintain at this level, if they're going to creep a little bit higher, or if they're going to pull back. Don't know at this point. We're going to keep watching it, and we'll let you know certainly as we see some things change. All right, let me pivot a little bit. Legislation, which just made its way through Congress, literally as of the time of this recording, just signed this afternoon by the president, which means it's law. And that's one of the reasons why I wanted to get on this recording pretty quickly so that we could get it out to you as quickly as possible to give you some of our reflections on what is included inside of the legislation. We're going to stay away from the political discussion parts of it and just talk about some of the nuts and bolts. So several things which may be pertinent to you, they may be pertinent to family members, may be pertinent to folks you know, loved ones, colleagues, all of that good kinds of stuff. Let's talk about some of the big points which are included in this legislation. First big one, direct payments. There are going to be direct payments for those who income qualify in the amount of $1,400 per person. Let me say that again. Direct payments in the amount of $1,400 per person for those who qualify from an income standpoint. Next question, of course, is who qualifies? So if you file as an individual and you have $75,000 or less of income, if you file as joint, meaning married filing jointly or head of household, and you have $150,000 or under in terms of your last tax return, which you have filed, you will qualify for that $1,400 per person. Also, if you qualify for that and you have dependent children on your tax return, then you will also receive $1,400 per child as well. So if you get mom and dad or in a couple of children, it's very easy to see where you may receive direct payments of several $1,000s. It's going to take some time for them to get it out. Again, just like I've said with regards to the previous bills which have been passed, just think about this logistically. It's pretty overwhelming for anybody to think about the tens of millions of distributions which have to be made from the U.S. Treasury in order for this to happen. They obviously have a better idea how to do it now than they did a year ago with the CARES Act when it was a very new idea and a new kind of push out. But it's still going to take a little bit of time. So give them some breathing room in terms of getting it out there if you do qualify for that kind of thing. Again, direct payments to individuals, direct payments to folks who may qualify for that, also for their dependent children as well. Second big item, if you are one who has been part of this, or family members or folks you know, unemployment insurance. There has been an extension of what I have been calling internally bonus unemployment. All that means is that if you qualify for unemployment during this time, and you are entitled to receive, quote, normal unemployment benefits, there is an additional benefit of $300 per week, which was supposed to end in mid-March. Now it has been extended through September of this year. Let me say that again. So for folks who may qualify for unemployment insurance, that bonus unemployment was scheduled to end in mid-March. That has now been extended to the end of September. $300 again each week for which you qualify, in addition to the normal or requisite unemployment for which you may have qualified in, quote, normal times. So that's a very big deal as well. If you're in that space, you know folks who are in that space, that additional unemployment is going to continue to pay so long as you qualify, again, through the end of September. Third big item, small businesses. A whole lot of allotment for small businesses here, again, for the obvious reasons. Those businesses which have been negatively impacted by COVID-19. I'm not going to get into all of the packages that are out there, but there have been several new allocations for disaster loans, for long-term loans for which you may qualify from the SBA or the Small Business Association. Very favorable terms for which you may qualify. You definitely want to take a look at that if you're a small business owner. Also, if you are a restaurant owner or know folks who are restaurant owners, there actually was a separate allocation, a separate grant-making allocation inside of this bill to be able to be a source from which restaurant owners can request grants, which would be forgiven then for helping them with payroll, with inventory, with lease payments, mortgage payments on their properties, those kinds of things. So definitely, if you're a restaurant owner, take a look at that. But for small business owners overall, again, a lot of possibility there for you to take a look at new programs, new funding, which have come through in this bill. Now, there have been a number of things which were included in this bill which weren't a part of previous bills. It's one of the reasons why literally it's the largest financial relief or financial stimulus bill that we've had on a relative basis since World War II. 1.9 trillion. I can't even imagine what 1.9 trillion actually looks like. I mean, I can see the zeros on the page, but it's really hard for me to fathom it. So there are a number of things which are included in this this most recent round, that 1.9 trillion, which were not part of previous rounds. Most especially, 350 billion of it has been segmented for states and municipalities to be able to address shortfalls or shortcomings in as far as they are concerned. So we're going to see some direct payments made, again, to states and municipalities, a significant portion of this bill which has passed. There obviously are a number of allocation points, different distributions set up for healthcare agencies, hospitals, those folks who are providing care, inoculations, vaccines, a number of different veins there to be able to fund those entities as well. And then in addition to that, there also is some allocation for some things that arguably are not particularly related to COVID. I'm just going to raise one of them here. There happens to be $10 billion set aside for infrastructure. Yes, literally, roads and bridges. So there is an allocation inside of that as well, probably because there's going to be another ask sooner rather than later of Congress to come up with a much larger infrastructure bill. But there was a small segment of it that was included. I say small. I never am going to think $10 billion is small. But relative to $1.9 trillion, the size of the overall bill, this one was somewhat smaller. So again, those kind of parts are included in this bill as well. I'm not going to get into all the different segments on that. Just want you to be aware that this is gargantuan. Certainly when we look at it in the context of history, there hasn't been much outside of the CARES Act of last year that has been anywhere near this size on a relative basis since World War II. Even the bailouts that were part of 2008-2009 financial crisis pale in comparison from a size standpoint to the kinds of things that we're considering here today. So again, staying away from the political aspects of it, the political discussion points on it, just on a mathematical basis, that just happens to be fact. So very, very big, very important that you take a look at the different nuances, especially if they apply to you, family members, friends, colleagues. You want to be sure that you're aware of what's included in this new bill, which now has become law. Well, friends, I want to be respectful of your time, so I'm going to draw my comments to a close. If you would like to chat about this most recent round of legislation or the markets, or more fun stuff, especially as the weather is starting to warm in most of our places around the country, and we're beginning to think about spring again, and hopefully what will continue to be some reductions in the amount of restriction from a travel standpoint, from our ability to gather. It does provide a very good note of optimism as far as I'm concerned. It's not going to be a press button and all of a sudden everything's back to normal again. It's going to be a process more than an occasion, but we certainly seem to be moving in that direction. So let's keep our fingers crossed and hope that the amount of infections and resultant deaths from COVID-19 continue to decrease, as they certainly have here over the last couple of months, and that again we can resume some of our activities that I know all of you and I have missed so very much here over the last year. Friends, thank you so much for your time, for your attention. I appreciate you so much. It's always good when you reach out via email or phone. I always enjoy hearing from you. Please, again, if you would like to do that, to chat about these things or anything else, with the warm weather, I'm starting to think about baseball and certainly our Pirates. It's going to be an interesting kind of season on a number of levels, as we have a number of new faces again. Maybe I'm going to take in a little bit more high school and small college baseball this time around and see what maybe the prospects there. But I hope that you have opportunity to enjoy this time again as the weather warms, and that hopefully we'll be resuming some more normal sooner rather than later. Friends, again, thank you so much for your time. I appreciate you so much, and until the next time, I'll look forward to talking with you soon.